Hello, everyone.
Hi.
Hello.
Hi.
Welcome back.
Yes.
Yeah, sorry, I'm trying to adjust my
hi.
slideshow so that only show one page instead of 2 pages. How was your lunch, everyone?
It's good.
Good, ah?
Good.
Okay, that's very good. Just give me a few minutes. I don't know why suddenly the slideshow has changed. So let me just off it. Okay, can we just go through some recap? Okay, on this chapter 3 just now on analysis. Okay. Can you tell me what are the reasons for auditors qualifying a report? Everyone just on your video if you don't mind. Okay, you just tell me what are the reasons that an auditor would qualify an account. Or before that, how many types of opinion are there from an auditor?
4.
Yeah, what are the 4?
Qualified account,
Qualified,
unqualified, adverse, disclaimer.
Adverse disclaimer.
Okay. Under what usual circumstances would auditor qualify an opinion?
Compliance. There are any uncertainties?
When there are uncertainties. Uncertainties on what?
The values of asset.
Yeah.
Okay. What other example? The very common one?
Going
Going
concern.
concern.
Going concern. Non-compliance with approved accounting standards, yeah? Usually, sometimes when accounting standard has changed, some companies doesn't want to change for whatever reasons that they have lah. Okay, so usually before an auditor publish their opinion, they will go to the management. Okay, what would the process be? They go to the management to ask them to explain, right?
Yeah.
Warning lah. Okay, if the management explain and everything is done according to the auditors, explain to the auditor's satisfaction, what would they do?
Qualified. Unqualified.
Unqualified. That means if they're happy with the explanation, they won't do much. They will say, okay, I'll go along with your explanation. Unqualified. But if they are not convinced, then what is the next step?
Qualified. Rectify the situation.
They will give them a chance. Give them a chance to rectify first lah. Okay. If they manage to rectify the issues quickly, because you see, by the time the auditor finish auditing and have this management discussion, it would be, say, a few months after the closing already. Okay, and they are supposed to have the accounts ready within 6 months. So they will ask the management to rectify the issues quickly. If the management can do it, what will the auditor do?
Express qualified opinion.
Unqualified lah. It means you manage to rectify whatever I ask you to do, so they will be happy. They won't do anything else lah. Unqualified, okay. But if the management fails to do that,
Qualified.
then it will become qualified. Okay. So remember that is exam topic. Just auditor's opinion can be 2 on that. Okay. Then auditor's opinion is one of the notes to the account and all those which is very significant for us, for lenders as well as all the general stakeholders. If you are investor and you see auditors raising red flags, then you will be very careful. Okay. Then tell me what are the good examples of good analysis? Good analysis of
and
financial
qualified
statement.
opinion.
Sorry?
Good analysis.
Yeah. Okay. Is elevator analysis good one?
No.
No.
No. Is integrated analysis a good one?
Yes.
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 Okay. Under integrated analysis, there's one theory which likes to come out in the exam. What is that theory?
Mosaic theory.
Mosaic.
Mosaic theory. Is there a thing called prospective theory?
No.
No.
Prospective.
So theory, only one word goes with it in the textbook. It's called mosaic theory. Okay. Then under classification of reserves, dividend can be paid out from where?
Dividend pay out
profit.
from revenue.
Earning.
Revenue from earnings. Okay. Before dividend can be paid out, the Companies Act states there are 2 tests. Number 1, it can only be paid out from profit. What is the number 2?
Solvency.
Solvency. They cannot pay so much dividend until it makes the company insolvent. Yeah. Okay. What else can revenue reserves do? What can it be used for? Revenue reserves, that's capital reserves. What else can these revenue reserves be used for?
The future distributions as dividends or loans.
Yeah, to issue shares. Yeah. Okay. Then capital reserves. Capital reserves arise from what?
Capital transaction.
Valuation.
Capital transaction.
Yeah, from the revaluation of assets. It can also arise from forex or derivative transactions. Yeah. So what can capital reserves be used for?
Bonus issue.
Bonus issue. Can it be used to pay dividend?
Cannot.
No.
Cannot. Okay. Then this cash flow statement. Now I show it in my screen. The acronym is just OIF. Operating activities, investing, and financing. What are the items that affect operating cash flow?
That has been from
Operating, remember operations, right? So usually in the operations, what does the company has?
NWC.
Good. NWC. So NWC is net working capital. Net working capital comprises of
Stock.
Creditor, debtor.
Creditors.
Creditors.
You guys, I'm sure you score with distinction. Purposely scroll this very later than what you're saying. You got it right. You got the stock or inventory, creditors, receivables. Okay. So under investing, under operations first, is all these stocks, net working capital. Then under I, what do you have? What will affect the investing cash flow?
Assets. Capex.
Capex, which is usually means fixed assets Okay.
R&D.
So
R&D.
R&D. When you purchase fixed assets, you use cash or you generate cash when you purchase.
generate cash.
So you see a minus here, When you dispose of a fixed asset, do you get cash or you spend cash?
Get cash.
Get cash. That's how you see the negative, positive here, okay? When you receive dividend income from your investments or from your subsidiaries, what do you get? Cash, right?
Cash.
Yes.
Okay, so you see a plus here. So after that is financing. Financing here, the word means borrowings lah. Okay? So borrowings or you raise funding. You raise funding from the from your shareholders lah. Let's say Sendirian Berhad, you just go back to your shareholders. If it's a listed company, you got a lot of shareholders. Okay? When you issue share capital, is it use cash or generate cash? When you issue share capital,
Generate cash.
generate cash. So you add up. Okay. When you go to the bank and take more loans and you draw down on the loans,
Generate cash.
Generate cash.
then every month or every quarter, as and when you repay your loans and you repay your interest, you use cash. That's why it's minus, okay? And then let's say you are Bursa listed, you got a few subsidiaries, they pay you dividend income, that is at the top. Now it's your turn to pay dividends back to the shareholders. Okay, let's say you are Samdabi. Samdabi has a lot of subsidiaries, they receive dividends. Then Samdabi Berhad itself declares dividend and pays dividend. So when you pay dividends, it is minus. Okay, you pay out cash. So this is all you need to know. Is actually just but you don't have to remember, disposal plus, right? You just ask yourself some logic lah. Okay, when I sell things, do I get cash? When I draw down loans, do I get cash? That's all. Okay. But then, as usual, there are limitations lah. What are the limitations in financial statements? You just shout it out. There are a few slides here.
Static.
Static, yes. Some more? Static is historical, right?
Yeah.
And then cash flow and all that, it doesn't tell you the exact timing. There's also seasonal swings. Let's say in 1 year I do well. You see some companies, certain seasons they do better, especially if they are in the retail line. They sell like Hari Raya, Deepawali, Christmas. So certain months their cash flow swings up. Certain months it swings down. Okay? So you cannot predict. Neither can you predict for next year, will it still be the same or not? Will it still have the same pattern? Or is it due to a one-time contract the manufacturer gets, suddenly they get increased? Okay, so there are some limitations, yeah? Just now we have gone through this. Now we come to the calculating. If you need to go and get the coffee, you go and get, never mind. Okay? Because I needed a coffee myself during lunch break. Okay, so there are 5 categories of ratios, yeah? First one, you go to solvency. Solvency is just known as liquidity ratio. Can they pay the short-term obligations that they need? The short-term obligation is within the next 12 months. Just like us, we have to, I take ourselves as employees. You got to pay, let's say you go and makan in the coffee shop every day, you got to pay petrol, you want to make sure you can meet this. Once in a while, when your term loan or housing loan is due, you may not be able to pay within that day. You can pay, you may just take a few more days to pay. For the company, it's not every day lah, so it's within the next 12 months. Okay? So this got 2 ratios only, current ratio and asset ratio. It is quite similar. I will tell you why. Okay, current ratio, this is the most simple one, that is current assets minus current liabilities. If you have a low ratio, it indicates what? Okay, let's say you cash is at the top, right? Okay, so you will have low cash, but you have more liabilities, it's less than 1 time, so it's not good lah. If you are a lender, you say, wow, you got more current liabilities, more things due than assets that you can sell off to repay. What are current assets? Stocks, right? Debtors, you want to collect from them. Okay, you have cash to settle, short-term loan, short-term creditors. So I ask you one example here to calculate for me. Let's say a company has cash, 100K, stocks, 200K, and then receivables. At this time, how much is their current assets? Can you just shout out? Just what I typed inside the
500.
500. Okay. Then now we go to the bottom, denominator, okay? How much is my current liabilities? Just based on what I've typed in the chat, overdraft 100, trade creditors another 100, accrued expenses 250. Okay, if possible, everybody type, because why? In the exam, everybody will be doing your own calculation. You cannot peer over the shoulder of your head, of your colleagues.
Hello.
Yeah.
May I ask how to get 500? The top one. Cash plus plus all.
Wait, sorry. Just now I typed wrongly. Okay, 100 plus 200 is 300. 300 plus another 200
200. That's
is
plus all.
400. Is that your question? Sorry.
Yes.
That's your question, Okay. The second part, the current liabilities.
Ma'am, question. Cash 100, stock 200, receivable 200, 500. Which page? The formula.
Oh, which page? Just now here.
Formula.
Current assets. It's called current assets.
Current assets divide by
Let me
current
find the page.
liabilities.
You first of all, you understand what is current assets or not? Slide
Yes.
63. You go back to slide 63. Let me try to go back. Sorry, I scroll a bit slow. Otherwise, I could get out to come in back again. Current assets can be converted to cash within the next 12 months. Okay, so it comprises of raw materials, finished stocks, receivables. Okay? That means the things that you can turn into cash. Of course, cash itself is already cash, is under current assets. Fixed deposits. Boleh? You must answer me before I go on, please. Can or not first? Can,
Yes. Okay.
Yeah. Why we give you this slides first, so that when you go to the following slides, then you understand what is current assets, what is current liability, and all those. Okay. This one is current liabilities. Things that is due within these 12 months. Okay. Okay. So you calculate the current ratio. Most of you has done it. Okay, it's good. This very simple example you can understand. So after this is another ratio called asset ratio. Asset ratio basically say you don't take into account the stocks. Yeah, let me go down again. Okay, just now we were here, right? Current assets, okay? It's called a quick ratio. That means or asset test is you need to sell stocks. After you sell, make some sales, then you need to collect. Sometimes the cash sales, sometimes it's credit term sales. So if something is due very fast, you cannot wait for the stock to be turned into cash. So when it says quick ratio, that means you minus the stocks. Okay, using the same example, can you calculate your quick ratio for me? Now you calculate the quick ratio. Can you put what minus what so that you can understand also? Everyone? Yeah. Just now at the top was 500. If you take out the stocks, just now this one. So you only have 100 cash and receivables 200. So it's 300. Okay? But your bottom current liabilities, what you hutang people is still the same. Your overdraft, all that is still the same. So 300 over 200. I see most of you get it now. Liban, yeah, okay, Liban. Okay, so if there's one question on solvency ratio, there's only two ratio here. You sudah dapat lah. Sudah dapat satu markah. Okay? That one can, So the next one is gearing ratio. You see there are 5 types of ratio. We've done with the first one, solvency. Now we are here, gearing. Under gearing, there are ada 4. Okay, 4 of it. Gearing means you use other people's money. Okay? Basically, that's what it means, other people's money. And this is a exam topic. So you just pay attention. It actually means you rely on external debt versus what your shareholders put in. Okay? It does not measure your ability to service debt because it includes total liabilities, long-term, short-term. Okay? And generally, when they ask you is there a magic number? There is no magic number over gearing. It depends on the industry. Okay? So we go into one by one this ratio. Okay. The formula is total liabilities over total assets. When it says total, it means current and non-current. Okay? Current, non-current liabilities over current and non-current assets, total assets. So in the balance sheet, you will find this number in the balance sheet. It's given one. However, just be careful. The name they call this ratio is debt asset ratio. The calculation is not that because most of us take that as bank borrowings. But total liabilities includes creditors and all those. So although you use the word debt, the formula uses liabilities. Just highlight it, yeah? So although they call it gearing, which usually means just bank borrowings, but it's actually leverage ratio Okay? Is total liabilities over total assets, which is not just bank borrowings or your HP. Can somebody just take a picture of this leverage one? Just put inside our WhatsApp chat. Who can volunteer to do it instead of say out your name? Somebody, please volunteer
什么？
to snap a picture.
Okay.
Thank you.
Remember.
Why I say that? Because okay, all of you come from RHB lah, but in the exam it's different banks. Some banks they define gearing as just bank borrowings. And then you say, gearing ratio ada 5 ke? So in your mind it's always just bank borrowings. It's actually leverage ratio. It is a very textbook thing lah. Okay. So remember what is this called? Total assets, denominator, right? You see the next ratio, they also use total assets. Only the top part has changed, which is shareholders' equity. So they call it equity ratio. Okay? One exam question it has come out before. They track you. They don't ask you to calculate with numbers, They give you two ratio and ask you, what is the common denominator between leverage ratio and equity ratio? Number 1, total liabilities. Number 2, short-term liabilities. A, B lah. C, total assets. D, current assets. What is the common denominator? You tahu itu ratio, but you don't understand the word denominator, you tak boleh answer. So we tell you first, denominator means the pembawa, the down one, okay? So common denominator is total asset.
Total asset.
Total assets here. So now I type in the chat one example. You calculate. What is the leverage ratio first? Can you type? Just now the first ratio that we learned. Can you please type in the chat, everyone? Okay, it'll be good if you can just don't jump. What plus what you add it in there. Can? Thanks, Perry. You got it. How about the others? Waiting for the others also.
你教我什么？这个是谁画的？我看你嘴巴是什么？你给妈妈看，很恐怖诶！你吃糖果对不对？
糖果来的。我今天一直跟婆婆去吃，然后我一直做梦哎。
你做什么梦？
我今天去马桶啊，是我做的吗？
Okay, I'm typing. total assets remains the same lah, okay? But now the total liability is 10 million. You have to calculate the second ratio, the equity ratio. Just now total assets 25 million, long-term liability, short-term liability, okay? But now I just tell you is this, total liability. Let's say it's 5 plus 5 equals to 10. What is the equity ratio now? Do you remember the accounting equation? Asset equals to liability plus equity or capital. I didn't give you, or in the exam, I didn't give you the capital put in by shareholders. But I give you total assets 25, total liabilities 10. Please calculate the equity ratio. How about the others? Do you understand? If you understand, then you type it in. If you don't, you ask me. Okay. Okay, you got it? Understand? So this equity ratio will tell you is the asset protection. Meaning, if you have asset so much and you have equity, let's say, now it's 0.6 only. So you know that it's not as good. If you want to put in more equity, right? Just now was assets here at the bottom. Now and equity is at the top. So the third ratio is they just terbalik, they bring the equity down, but at the top they put liabilities. So now it's total liabilities over total equity. Again, they use the word debt in the name, but in the formula it's liabilities, not just bank borrowings. Okay, so it's total. Now can you calculate the debt equity ratio based on what I've given you? You know the total liabilities based on the latest total liabilities and the equity. Total liabilities is 10. So you can see the ratio is not very difficult. They sometimes like to terbalikkan what is at the bottom denominator in the next ratio, they bring it up. Okay, numerator bring down to denominator. Okay, the cube. Then shareholders' financial commitment over long-term asset. Shareholders' financial commitment, we have teach you before that is 3 types. Shareholder can be shareholders' funds. Okay, it can be subordinated loan, it can be collateral, it can be pledge of FD. So when we say shareholders' financial commitment, let's say I give you the example this morning. Petronas go to Vietnam and Indonesia. Petronas will say, okay, because they are so big, they go over there, they team up with the local partners. The local partners may not be so strong, so they need to give a little bit of FD. So Petronas say, okay, I put in 10 million FD. Okay, come from Petronas Malaysia. So it is an off-balance sheet item, but it's still a financial commitment. So when it comes to shareholders' financial commitment, why we use long-term asset, not long-term and short-term? Because shareholders' financial commitment is like permanent inside. So we look at the more longer-term asset. So we use long-term asset. So only this ratio is slightly different, as in it's all long-term thing. Long-term shareholders' financial commitment over long-term asset. Okay, it's not to say very difficult, but this is something that you just need to remember. Shareholders' financial commitment can be in the form of paid-up capital, can be in the form of a subordinated loan, can be in the form of third-party collateral. Okay. Over here, can you underline in your own book, in your own thing, is subordinated loan, collateral. Okay, and then here shareholders' financial commitment, because it's long term, you write there financial commitment must be long term law. It's like you kawin is long term, right? You not dating only, right? So you have put in money, so it's long term. So it's over long term asset. Okay. Debt service ratio. We finished all the four already. Now we go to debt service ratio. There are two here, times interest earn ratio and interest and principal coverage ratio. Okay. This is basically, we say, assess the credit worthiness, whether they can service their debt or not. Because some borrowers, they can be asset rich but cash flow poor. They got a lot of asset, but it's not churning cash. So you want to calculate. For retail lending also, you want to see whether the individual can service the debt from their salary, from their other business income. So this is one of the principles of lending, right? We say debt service. Okay, I give to you first. The normal one is called earnings before interest and taxes, EBIT. Accountants like to use short term, E for earnings before interest and taxes, divide by interest expense. It shows you the ability to pay interest, because interest is due. The moment you cannot pay interest, it shows a very, very poor debt servicing. Sometimes people cannot pay the principal, but they must service the interest. If interest still tak boleh then it's very, very weak. You have to make provision for your borrower. Okay, so it's called EBIT. If you know, just now we have quick ratio, asset ratio. This one also got something. It's also EBIT, but you have this depreciation and amortization, so EBITDA. Okay. They can, when they ask you, what is the debt service ratio? In the exam, you look at the question. If they give you depreciation and amortization figure, then you use it. If they don't, then you don't have it. You just stop at EBIT. Okay? Nothing to worry. They will just tell you, you got earnings is like this, interest is like this, taxes is this amount, depreciation is this amount. If there is, then you add it all together. If there's none, you just use EBIT. This one will give you a little bit, just extra. Is EBIT plus interest expense divided by interest expense. You see or not the difference? It is interest expense. All the denominator is just interest expense. The other special. This one is EBIT, EBITDA. If they give you the DA, we call it DA. If they give you the DA figure, you put in. This one add in interest expense. Why? Because accountants, they like to calculate until the last dollar sometimes. So, okay, there is some tax formula here. Okay, they will give you this. This one, in our calculation, sometimes they ask you, most of the time they don't ask you to calculate even with tax. They will just go to the simple one. Okay, EBIT, EBITDA, and this. Just remember, if you have to divide out for this, because why? The interest expense is not tax deductible. So they will give you what is the tax rate, 20%, 25%. Later, when we do a question, then you can see how to plug in all this, okay? Maybe I ask you to calculate first, I have NPAT 200, interest expense 50, tax 150, depreciation 500, amortization 300. Then you have principal repayment. Can you please calculate what is this times interest earn ratio? Number one, you use EBIT. Number two, you use EBITDA. You just calculate and see. The earnings here is NPAT. Okay, there is earnings before interest and tax. Can you calculate, please? You use the simple one first, EBITDA. Okay, EBIT. Yeah, thank you, Perry. You got it, EBIT. How about the others? I just want you to have a go.
等一下
Okay,
break
Liven,
的时候我
thanks.
call 一下我 senior，我再看你要不要出去。
Suraya? Brian, are you around?
Yeah, around.
Yeah, okay, can you calculate that? Thank you. Hafiz, CJ, Un, Haley. Yep. Asmida, thank you. Tazo Asri. Okay. Now you calculate using the formula EBITDA. Using EBITDA also, Vijay, thanks, you have calculated EBIT. So now you calculate EBITDA. So in the exam, sometimes they give you depreciation and amortization figures, sometimes they don't. So you have got it here lah. Okay, very good, everyone. Now you're getting the hang of it, yeah? The formula looks a lot, but actually it's not difficult, okay? Thank you, Hafiz, Paley, Vijay again. CJ has done it, Perry, of course. Suraya, okay. Okay, now we go on to the next slide, if you all get it. So just now we say gearing means you borrow money from the bank and the bank gives you different types of products, right? What are the 3 types of banking facilities, the risks involved? So remember, TCA is an acronym. T stands for trade products, C stands for capital, long-term loans we give, okay? A is advances. Can you tell me out of this TCA, 3 types of products, which one has the highest risk? Just tell me, and why do you think it has the highest risk? And then another person tell me why the other product is of lower risk. I know it's after lunch. Can everybody just on the camera a bit? Vijay is already on, thanks. Okay, thank you. You can see the slide here, the TCA. Why? Okay, it says here, trade is lowest risk. Why is it lowest risk? Can you just make a guess?
Purpose for business.
It's
Purpose
backed
of
by
business?
trade documents.
Yes, good. The principle of control, right? You can control the drawdown. No documents, no drawdown, no money. Got documents, you can draw down, means you got business. Okay? Now, why is advances the highest risk? Why is advances?
Because you got no control.
No
it's not
control
backed
for
by
the usage.
trade documents.
Okay. Yeah. Okay. Overdraft, they can just, it used to be people write a check, now you can do banking transfer, right? Revolving credit RC, you go by 1 month, 3 months, and all that. No, I would say no documents to show you where and how they're going to make use of the money. You just look at the balance sheet. If you think they're strong enough, you give them a bit of this. Okay. Capital expenditure is somewhere in the middle. Because why? They want to buy a factory. When they want to draw down, you have, your ESR under your documentation side. There's a sale and purchase agreement, there's land search and all those. You do have documents, you do have lawyers to help you to look at it. Okay. But why is trade is of better risk than the capital expenditure, since both of these got documents? Both also you can control, Why? Why trade is of lower risk than capital expenditure products?
Short term.
Trade related is short term. You look at the operating cycle. If the cycle is 90 days, they give credit terms 90 days. Of 120 days, you should come back. And usually banks will put in a condition, hey, the proceeds of these trade bills must come back to RHB Bank. So money go out, 90 days, 120 days, or 180 days at the latest must come back, right? Yesterday we study under FEA. If you export, export proceeds must come in. So you can see it. Whereas capital expenditure, at the drawdown, you can control. But at the repayment, you depend on the operational cash flow. You don't know where it comes from, whether they have enough money or not. So it's a little bit higher risk, okay? And then advances is the highest because both the drawdown and repayment, you don't have control. Okay, the next few slides will tell you. 3 types of gearing. You look at the track record, the economic environment, and all that before you lend. Trade related, properly structured, you have control, right? Obligations are variable. The bank is not locked in. Hey, you don't have enough trade, I cannot let you throw down. Somebody says tender is short term, very good. And repayment is assured because why? The proceeds will come back. Okay? So anything short term, first cycle, let's say 90 days, they are a bit late in repaying you, your antenna warning signal is up. The second cycle, if they are late by another 1 week, you quickly look at it, you put it under what? Watch list. You watch over the account carefully. If you need to, then you downgrade. So this one, you are watching it all the time. You can monitor it. Capital expenditure, you have sufficient control, as we said, at disbursements. But when it comes to repayment, you have to see. And sometimes the repayment is only once a month, every month. So first month, they will tell you, sorry, my tenant pay me late, so I pay you late. You may believe it. Second month, third month. But after 3 cycles, then you say, but actually they lost the tenant. I give you this real life example. My own account when I was in a merchant bank, I lent to a listed company that has this land next to Concord Hotel, Jalan Sultan Ismail. At the time, it's not so well developed. So what they do is they build a nightclub. They rent out. They don't run the nightclub. Why? Because they're actually the listed company wait for the land to appreciate because KLCC was coming up. So during that 3 to 5 years, they just want to put out a simple structure, can rent out, they rent. And then I collect rental every month, I happy. Review won't happy. And my bank is very near. They ask me, want to go in and visit the nightclub? I say, no need. I don't need. I can see it's there. Then one day, the management of the nightclub closed down the nightclub, The building is still standing there. The customer is still servicing the loan because I asked them rental proceeds must come into an account with my bank, which they come in. During annual review, first year, I didn't ask them. Second year, or interim review, when we have lunch, the accountant was very good. He came and told me, actually, the tenant, we finished the tenancy. They shut down already. We didn't lend. You did? We didn't rent out to them. Then I said, where you get the money to repay? It's from our own company. Our own company got cash. I repay you every month. So at the drawdown, I got control. Repayments still keep coming in. No outstanding, no areas, very good. But what I didn't know, my monitoring not so good is, I didn't even know that the rental has stopped. Although the rental agreement can be longer or whatever, they have stopped. And then the customer say, actually, we are talking to some potential buyers we want to sell. You see if this one go through, we sell. If not, we wait another 6 months, then we get another bid, then we will sell. Okay, capital expenditure. Advances, this one evergreen one. No systematic reduction. Even if some banks, they may have say, okay, RC, I give you this amount, then next year we will reduce and all that, but you still have no control over it. Okay, potentially evergreen. You look at the track record, Let me just ask you, this one from your experience. Let's say company A, their gearing ratio is 2 times. Let me just type here. Okay, company A, the gearing ratio is 2 times. Company B, the gearing ratio is 1 time, which is better lah on formula. Okay, but company A, there's no late in servicing the loans, no late payments. Company B, once in a while, but a few days late. So when you look at this slide to say proven track record, which one do you think has a better proven track record? Yeah, thanks Perry, Asmida, Aiden, Insun, okay, and all the rest, yeah? So it is not just isolated analysis. Isolated, wow, this one gearing better, it's isolated, but you have to look at it comprehensively, okay, integrated. So you look at the secret record as well. Thank you, everybody. Okay, ratio analysis, I'll go fast here. You look at the economic environment. Why trade is better? Because in a good trade environment, good economic environment, they got more business, you give them more trade loans, they can draw down more, it's okay. If it's not good, you can control the utilization there. CapEx, once you release, let's say now it's good, you lend to them, 2025, they give you 2022, 2023, and 2024 financials, post-COVID, things are bright and rosy, you lend to them, then they draw down. But 2026 onwards may not be so good. Okay? So CapEx, when you lend, you look at it, yeah? When the financials are good, you lend, but you have to see the debt servicing, okay, in the future. Okay, changes in gearing level. We should be concerned if their gearing rise significantly from year to year if they cannot give you a good explanation. Later you will see, during the boom time, most companies would want to gear up, so they will borrow more. At the same time, you must tell the company to put in more shareholders' financial commitment so that their gearing is at a palatable level and you know that they can service it. Why? Because what they borrow from you for long-term capex, it will take time for them to produce the material to sell and collect back to repay you. So there's a time lag. Okay? Trade related, the time lag is very short. As I say, it's operating cycle. Capex is longer. Okay. Now we come to this asset management ratios. Okay, operational efficiency ratio. How efficient are they in dealing with NWC, net working capital assets? So you have stock, you collect from your receivables and then you pay. This is on operational side. The asset side is this fixed asset and asset. Average collection period, you take your 365 days time, trade debtors balance over sales. Of course, it will be best if you can get, if they tell you what is the credit sales. If you cannot get credit sales, we just take total sales. Why? Because when you get financial statement, you know revenue, the sales for the year lah. Okay, sales for say 2024 is so much, but you wouldn't know the credit sales. So if you don't know, you take total sales is okay. Again, average trade debtors balance, you're supposed to know what is the opening trade balance, closing, and then you take the average. If you don't know, you just take the closing trade debtors balance. It is okay, and it is very often we just use this closing trade debtors balance as numerator, and at the bottom we use revenue, sales. Okay? If you can collect fast, it's good. If you take a longer one, not so good. But again, you have to ask them, is it because their industry, very short collection period, like I say, supermarket, versus say, contractor. Different industry has their different norms of collection period. So you see whether the norm is 30 days, 60 days, 90 days, or whatever. Okay? This is the first part, collection period. The second one is stocks. Remember, we buy raw material, we turn it into work in progress and sell, or if it's a trading company, you just buy and then you sell. So again, you take 365 days, divide by what is the stock balance, divide by cost of goods sold. Cost of goods sold is usually given to us inside the profit and loss account. Average stock balance is supposed to add the beginning with the end and divide by 2. If you don't have, you just take the closing stocks. Okay? And if you really don't have cost of goods sold, let's say the examiner try to be tricky with us, they don't give us cost of goods sold, you take sales. You know why? Because it's usually we say, oh, cost of goods sold is say 60% of sales. Okay, another 10% will be operating expenses. Then gross margin is 30%. So you know, they will give you sales, then you just take the sales figure. Why? Because this is a ratio. Whatever ratio you take from year to year, it will be about the same. Okay, so average stock holding period, if it's shorter, that means they turn around the stocks faster, greater liquidity. Okay, if it's a longer period, let's say 1 year, you look at your customer, they show 90 days. The following year, it become 110 days. Then you ask why. Is there obsolete goods? Okay, is it because the management has changed, the CEO has left, and now they're less efficient? So you can ask them. Accountants very funny. Sometimes we like to terbalik. So they do an inverse. If cost of goods sold go up, instead of the bottom, they go up, and the average stock held is here, they call it stock turnover. Okay, this one is how many days, the first one. The second one is how many times. Let's say in a company, they can turn over every 3 months, they turn over 1 time, 90 days. So in a year, they turn over 4 times, right? So 4 times. Here, they count by number of days. It's just the inverse. Okay, nothing to be afraid, just the balik only. You know, it's just like us. When I go overseas, my name is Cheong Pui Wah. I go to Masale country, they always ask you to declare your name, first name, Pui Wah Cheong. It's actually one and the same person, right? So it's the same with ratios, okay? This is creditors law, how long we take to pay creditors. Now we are terbalik. If it's your customer, they want to have as long as possible creditor turnover period. So instead of paying creditor over 90 days, if they can ask for 120 days, they will ask. But sometimes they may be able to pay off fast, which is also good. Okay. So here you look at trade creditors balance. And here you look at purchases. So what if purchase information is not available? Then you use cost of goods sold. If cost of goods sold also not available, then you use sales as the denominator. In the exam, you just see, they want to calculate. So whether cost of goods sold, purchases, or sales can be at the bottom. At the top is trade creditors. Whether it's the average or the closing one, also can. This one we are in the exam, they will give you creditors figure, then you just take. Okay, you don't have to split hair thinking whether it's the average or closing. You just take it. Yeah. Just now was, remember, current assets, net working assets. We talk about stocks, we talk about debtors, we talk about creditors. Now it comes to the fixed assets turnover ratio. They have sales in a year, and what is your average fixed asset? This one is to tell you, let's say in a plant and machinery, how efficient are they in generating sales versus over fixed assets. And remember last month I was doing another RHB mock exam, and I happened to meet an old friend. She used to work in the same bank as I did, but now she's with RHB. So when I bring up this example, it's a listed company called London Biscuits. Straight away, your friend can tell me, "Ayo, Puiwa, it's because they changed generation. Father passed to son. Fixed asset is all there. They have expanded. But sales is a bit slow already under the sun. The sons take over lah. So the second generation was a bit slow. Finally, they cannot pay. One of the small banks, Nova Scotia Bank, call on the loan, and then it triggered cross report all over, and other bankers start to recall the loan. So why? You can see it from this ratio. And there's a reason. Your colleague was very good. She could tell me, oh, because you went to the next generation and they are not so hands-on and they like to buy luxury cars and all those lah. So in the books, you can see fixed assets going up, but sales is about there only, not going up as much as the previous years when the father was operating. Okay, assets turnover ratio is sales over average total assets. Just now was sales over average fixed assets. This one is sales over total assets. That means fixed assets plus current assets, all the total assets. Okay. So of all these 5 types of ratio, solvency would like to come out in the exam, and the debt service. The other ratios is more likely they won't ask you to calculate, yeah? You just have to know the concept. Now it comes to gross profit margin. Profitability is, I think, quite common by bankers. It just indicates to us how much is the borrower's earning capacity. They are profitable or not. Okay, this is bankers would like to know. The management would like to know. This is what the shareholders would like to know. What is the return on their equity? So you can see there are 3 here and then there are 4 here, but seldom they ask you calculations on this. So I'll go over very quick. Remember just now I told you, depending on what industry, like supermarket, they have high volume, but their profit margin is very slow. Why? Because they have very fast turnover of their stock. Okay, so gross profit margin depends on the industry. Supermarket, low profit margin, high sales. Cash collection, very good. In fact, supermarkets make a lot of money from putting cash with the bank. They have a lot of CASA. And then they minus off the other expenses, you get a net operating profit, net margin. But if you take a supermarket compared to a jewelry store has higher profit margin. Now, it doesn't mean that the higher profit margin, it is the better. You have to compare the players in the same industry, meaning you compare supermarket with supermarket, jewelry with jewelry. Let's say Tome, you compare with Pokong. Village Grocer with Jaya Grocer. That will give you an idea what is the norm in that industry. Remember just now we have one EBIT, we did the calculation. It comes up here again, earning before interest and taxes divided by average total asset. That is on your return of asset. Okay? Whether they are earning enough EBIT or not. EBITDA is something that analysts like to use in the capital markets, just to let you know. Okay, return on equity. We take net profit after tax minus preference dividend. Because when we say return on equity, we are meaning return on equity for ordinary shareholders. So NPAT minus the preference dividend, you divide by ordinary shareholders' equity. So the bottom we use ordinary shareholders' equity, at the top we minus the preference dividend. So you get, this is ROE for ordinary shareholders. This one will just tell you that you have profitability, productivity, overall gearing. Why do we exclude? Because we are talking about ordinary shareholders. And sometimes we less of extraordinary items. Because sometimes they make profit from reserves, they make profit from forex or derivatives. So you want to minus off all those extraordinary items, yeah? Earnings per share, again, investors like to know, hey, I put in this money, what is my earnings per share? Net profit after tax minus preference dividend divided by, why do they call it weighted average number of shares? Because in a listed company especially, beginning of the year, let's say they have 50 million payout capital. During the year, they issue 20 million shares, fully subscribed. So at the end of the year is 70 million, 50 plus 20. So they take the weighted average number of shares. It becomes a EPS. See here? Okay? They issue more security. And again, they take it on a fully convertible preference share, sometimes redeemable loans turn to warrants and turn to shares. Very seldom they ask you to calculate that deep because this is CCR, it's not your capital market exam. Capital market exam, they like to ask you this if you are taking the CFA exam, yeah? Then the next one, price earning ratio. Market price per share over EPS. Later in your mock exam, you will have some question on this. You can see, we can go through it. Now I don't want to take the time because sometimes calculation may come out, calculation may not come out. I prefer to spend the time on our low-hanging fruits where you can quickly get the marks on. Just know that price earning ratio is market price per share over earnings per share. Okay, let's say I give you this example. Now I Bursa listed share. My share price is RM 10 ringgit. Last year they earned, each share they earned, right? 20 cents. The number of shares outstanding in the market, the shares issued. Hi, can you see this in the chat? The price of a counter, quoted counter is $10. The EPS earning per share last year was 20 cents. What is the PER, price earning ratio? Can you do the calculation and put it in the chat, please? Okay, you got it. So if you're doing a further exam, then they'll ask you, is this a high PER or low PER? What is the valuation? Then that one is a different exam level, okay? But you got this because why? Shareholders like to look, oh, I put my money in, how many times am I paying for it? Okay, good, you got it. So again, examiner like to play around with us. Sometimes they take this ratio and terbalikkan, it becomes earnings yield. So earnings per share is 20 cents market price. Now can you calculate earnings yield? Using the same figures that I've given you. You have calculated PER, now calculate earnings yield, EY. Okay, you got it. Yep. So looks as though it's a lot of formula, but actually it's not that scary, yeah? So don't worry, yeah? Okay, we come to this slide, dividend cover. There are two formulas here. One is called dividend yield, dividend payout. You can see after they make money, right? As a long-term shareholder, you want to collect dividends. Just like some people like to buy public bank shares because they pay high dividends. Some people like to buy RHB shares because they pay dividend as well as share price movement. Okay, so dividend yield is annual dividend per share divided by market price per share. I use the same example, just now market price how much, earnings per share how much. If they have 20 cents, they don't pay dividend out 20 cents, they pay 10 cents. Same example, I put in the chat. Now dividend, although they earn 20 cents, but they pay dividend half of it, 10 cents. So market price is still 10 ringgit. How much is the dividend yield? Can you calculate, please, using this formula? Annual dividend per share, market price per share. Yeah, thank you, Perry, CJ, Un, Amira, yes. Okay, Janice, Eva, Kaylee, Asmida, William, Vijay, thanks, Raya. So you all get the idea, okay? When you are dealing with listed shares, especially they talk about market price, they talk about dividend. Sendirian berhad less lah. Okay, thank you. So now you look at the other ratio. Is total dividends paid to ordinary shareholders, net profit after tax minus preference dividend. Again, why preference? Minus out preference dividend? Because we are talking about the returns to our ordinary shareholders only. So this is a dividend payout formula. So a quick recap is there's dividend cover. You want to know as an investor okay, not as a lender, more of an investor, you want to know whether they can sustain to pay out dividend or not. So if I've been buying public bank shares, I say they can make enough money. Okay, dividend payout, we look at the policy. Some companies say we will pay out 50% of our profit of the year, just like the example I've given you. Some will say minimum 30% we will pay out. Minimum 30% they can pay higher. Okay, so if you're a lender to this kind of company, when you do the cash flow projection, you make sure that whatever profit they make, you allocate at least 30% cash will be paid out, cash leakage will be paid out. Okay, then that's dividend yield. Thank you very much.
为什么我的全身就突然不见了？在里面讲休息，什么都没有讲话，突然就不见。
滴滴是什么？
啊？
喂滴滴。
滴滴就是他 valid 不 valid 了。啊 shit！ 因为有一个露出钱，document 有错。
啊，这样点算？
我们叫顾客准备过活人，它上面有一个 wording 错了，
一个 wording 而已哦。
就legal方面就不对了，
这样怎么办？
它叫做 summarization。
怎么？
我在用针度，磨到很细的针。对呀，磨到很细。这是什么针来？
我念手指。
哦
我觉得不要好像给他这个给他电话，跟他讲他拿到100张好孩子卡，我们就给他送他电话。500张啊。
500，它现在只有多少？10张。
好孩子，好孩子，我们家给他的。
靠你！想到下次我们家给他。哎，我的全身就这样不见了啊！到底是什么事情哦？就真的没有了。 到底是什么事情？还没有啊？
没有。
so 奇怪。
Okay, welcome back everybody.
So,
If you are back, can you please on your video so that I can see you? Okay, thank you. Yeah, we do a quick recap. Just now we calculate solvency ratio, which is current assets over current liabilities. Then we have a second one called quick ratio, yeah? What do we list out from this quick ratio? You can go back to your own notes, slide 100 and 101. This is more of the common ratios that they may ask you lah, okay? The difficult one, not so much. Can you on your mic, please?
Leave out the stocks.
Yeah, why do we leave out the stocks? Why do we leave out the stocks? Do you know? What do you
Because
think?
of the liquidity.
More liquidity. Most
Yeah, it's most illiquid. It means you have to take time to sell the stocks and to collect money. Or if the stocks are partly raw material, you have to process it. Okay? So, this is I think the current ratio and the quick ratio is the simplest, and sometimes if it come out, you just get 1 mark lah. Very simple on this. Okay, between these two ratios, what is the common denominator? A is capital, B is total asset, C is total liabilities, D is current liabilities. What is the common denominator for these two ratios?
Current liability. Current liability.
Current liability, okay. Then you got gearing ratio, other types of ratio that comes in. But interesting one for exam is this. 3 types of gearing, TCA. Can you tell me what is T, what is C, what is A?
Trade capital
Okay, good. A stands for?
advances.
Okay. Which one has the highest risk?
Advances.
Lowest risk?
Trade.
Why? Why do we call it lowest risk?
Control. Shorter term.
Yeah, you have control and then it's short term, yeah? CapEx is somewhere in the middle, medium risk. Why?
Longer term.
Yeah, although you can control the drawdown, the purpose of the loan, it's productive and all that, but it's a longer term than trade. And the repayment, cash flow generation, you can't predict it, yeah, over the next few years. And advances is highest risk because it's evergreen. Okay?
absolute no control.
Yeah, no control, correct. Absolutely no control. You don't know where the money goes to. They may tell you, I need overdraft for my working capital, but sometimes I've seen customers, they apply, increase in overdraft, and then it becomes part of the first 10% payment for property they want to buy. Then they're taking 70%. Then you ask yourself, if the first 10%, they can't have their own cash, so if they later come back to you and ask for a property loan, do you want to lend? You have to calculate the debt servicing carefully. First, they ask you for incremental advances, overdraft or RC. They will just tell you that my business is expanding. Then they use it to draw down. Then after that, they come back to you and ask for a long-term loan. So you have to be very careful of that. Okay, they come step by step, not at one go. Okay, is there anything else you would like to ask? Like, in the mock exam, we'll teach you how to calculate. So I don't want to go over, ask you to calculate again. What is dividend yield? What is the gearing, EBITDA, EBIT? Okay? If none, then we will continue with this. Financial ratios limitations is the same as what we have discussed just now. Basically, it's historical data, is static. In the world outside, economic changes, business environment changes. there is change in management. Very simple. Business environment change. Today, the president of US announced a certain tariffs. Things will change, right? You can see very fast. And when it's not one country, he announced one country is affected, the other countries are also affected. And it's not just on one industry. Sometimes it can cut across several industries. So business environment change. Economic change, interest rate change. Some customers can stomach the increase in interest rate of 1%, but if your margins are very thin, 3-4% and 1% increase, there's a lot. You may not be able to have enough buffer for it. Okay. Change in management, we have already said. We have to look at the competency of the management. Can they keep up with the times or not? I think yesterday JJ gave you an example, right? A CEO of a bank and all that. There's change in management. Real life example is Starbucks. They used to have a certain CEO from the consulting industry. After joining for a few years, Starbucks price went down a lot. Market cap came down by billions. And then they hire another guy which is from another food and beverage retail chain. Immediately, even the guy has not even started work when they announced only the share price went up. So you can see change in management is very important, especially for bigger companies. Okay, financial ratios also will tell you not all businesses are comparable because why? There is this company size, different accounting methods, and they could have diversified along the way. So just like financial statements, they can only help us to a certain extent, ratios. You must use it on an integrated basis with other knowledge that we know about the industry. So the ratios are just like onion. You just peel, it just tell you, oh, it looks like this. Then you have to peel off layer by layer. You have to understand more, you have to analyze more, you have to talk to the borrower more and to the other industry players more to know what is happening. Okay, this is what we have discussed. All the ratios that we discussed is not meant for all the companies. Like construction company, do you think stock, debtors, creditors? Their creditors is they supply steel, cement, all this . Okay, debtors, if you are a construction company, you just got one paymaster to pay you, or if you got 3 contracts in your company, there's only 3 paymasters. Okay, so it's not meaningful for all the industries, all the ratios. So all this is just to tell you that it's a guidance, but number one is bankers, we must know enough of the industry that we are financing to. And then in order to know that, you have to know different businesses, the nature of the business. It does not give you a full picture of the company operations. Like the onion is just a starting point. Okay, I'd like to give you a few more examples of these practical aspects of financial analysis. Why? Because it's an exam topic. The slide 145 onwards, pay attention because a lot of exam questions come out from there. Practical aspects, those who have been doing lending, you will enjoy this. Those who have not been doing lending, you will also enjoy to know how your bank actually makes money. To collect deposits is a kind of skills, right? You have to sell to customers, CASA and all that. To make money from lending is another set of skills. Number one is always understand the nature of business, what your company does, what criteria impacts on them. Then only you start to analyze. Okay. Like I told you, different property investment holding company, they have different strategy. Some would like to own properties and rent it out long term. They like to own hotels, but they don't operate hotels. They work with Hilton and all that. Some like to rent out to, say, a village grocer or KK Mart. You know, you find KK Mart, all that. Some, like my previous customer, they really buy land at strategic places. They can even have money to build buildings, warehouses, but the end game, the long-term gain for them is not to collect rental. Their aim is to get the land appreciated and then sell. Okay, so for every industry and every player, you must know what niche that they are in. Okay, this is all the ratios we look at just now. You look at the asset consistency, whether the assets that they have shows what they are in, and if they have new assets, is whether they're diversified. And more importantly is always the short-term solvency, whether they can pay short-term or not. This is all the gearing we have talked about. Remember, there's no magic number for gearing. It varies from industry to industry, and even within this industry, which segment that they are in and which niche. For example, I tell you, the CPO, you can have just planters alone. You can have millers, or you can have an integrated industry, integrated player. They start from the plantation until the very end, which they have oil mill. Okay, IOI has that, Samdabi has that. Have you heard of Mewa Oil? Mewa Oil is an oil miller and trader. They borrow from almost every bank in town, including RHB. RHB is one of their largest lenders as well. They are listed in Singapore. So they borrow from Singapore banks, Malaysia banks, and they are in China, Indonesia. They also borrow from those banks. So, but they don't own plantation. So you cannot compare their ratios with another integrated player. Okay? So their gearing level is also very different, yeah? Remember, shareholders' financial commitment. Can you tell me what are the three things for shareholders' financial commitment? On your mic, please. I parrot this a few times because it's an exam topic. What are the shareholders' financial commitment? Just now, Master Trainer also has put a note down.
Subordinate.
Number one first, what is the shareholders' financial commitment is long term, right? What they have put money in. So what do you call that? Share capital, share equity, shareholders' funds. Okay? So again, retain profits, retain earnings that they have not withdrawn out as dividend. It stays inside the company to generate new business, okay, for further expansion. So that is also part of the shareholders' commitment. Number two, what is that? Just now you say that one is correct.
Subordinate.
Yeah. Actually, it's loans. Yeah, they make loans to the company. The directors make loans, or the shareholder, that means their holding company, make loans to them. But then you tell these shareholders, you tell these directors, hey, the company should not pay you off first, should pay us as a bank first. They say they buy a piece of land, they want to build another mill. The total project cost is 10 million. They put in 3 million. They borrow 7 million from RHB. And the project takes 15 years to pay back. Do you want them to pay the 3 million in the first 10 years, and then they take 15 years payback? So the first 3 million, they pay them back first within the first 10 years, and then they pay RHB bit by bit. But RHB only fully get paid at the end. Do you want that to happen?
No.
No, right? So when you look that to happen, you ask them, no, the shareholders, please sign this document called subordination. There's a document called subordination agreement or undertaking or just a simple letter. Okay, what they are saying is, I am subordinated to RHB. That means they must finish paying off RHB that particular loan before they can take back this shareholder loan. That is called subordination. Okay, and what is the third type of shareholders' financial commitment?
Collateral.
Yeah, third party collateral. Okay. What is a good ratio for this financials? Shareholders' financial commitment over long-term assets? It's 50% at least. Yeah, so if they want, they should put in at least 50%. Below 50% is not good. So when it's below, as a lender, what do we do? As a lender, we tell them we want to impose a CP here, write it down, condition precedent. Impose a condition precedent for shareholder to bring in more capital, inject more capital before they can draw down. Usually for a big project, for them to fully use this 10 million, it's not just 1 month they may buy the land, then they have to submit plans to draw up the building. They have to get approval from the government. And then they have to call for the contractors to build slowly. So what it actually means, it can be up to 2 years before the building is up. So you give them time. You can say, I give you this time to slowly bring in more capital until you reach this ratio, then only you can draw down on my loan. Okay? Another way is you say, you put in the money, the front end, shareholders pay. The back end, RHB come in. So front end means they have to put in all the money, draw down. Then you say, okay, you put in the money. Now as a banker, we put in our money. Okay? Not the other way around. Not you say you draw down first. The first 70% use my loan. The last 30% use your money. It's not that way. Okay? That's the practical aspects. Understand or not first? It means sometimes you have a certain ratio, you ask them, I give you time to put in. You put in this amount, you can draw down this amount. Or sometimes you can tell them, you put in all your amount first, then only you draw down my loan. That means one is front end, draw down is the back end. Okay, that's the practical aspects of it. Okay, you look at the 3 types of gearing, the TCA. Funding stability, long-term loan to finance long-term assets, short-term loan, finance short-term assets, okay. These are the key areas we look at. What is the core business? Now, what is the core business in the future? Is it sustainable or not? Okay. Then once you understand what is their core business, what is the nature of the industry, then only you look at what environment factors affect them. Just now, I told you earlier before lunch, in the black, in the red, what does it mean? In the red means what?
Losses.
For good.
Why? In the red is, last time, I don't know about your school time. My time, if I fail the exam, the marks will be given in red ink. If I pass, then it will be in the black ink. Let's say last time 50% was the passing mark. If I get 49, teacher will write 49 in black, in red, over 100. If I get 70 marks, then she will use a black pen. So in the red means losses, in the black means profit. Okay? Important is what? You look at how was the profit came about. The operating profit. Is it sustainable or not? Or you see a profit a lot of it comes from dividend income, which you know is not predictable. Dividend, different year, they get different amount, okay? Or it comes from a one-off, they dispose property. So the context in which operating performance was achieved. Do you all lend to glove companies or suppliers to the glove companies? I bring this up because this is an example. Glove companies, you all know by now that it does very well during COVID, and a lot of people jump into the bandwagon during the 2 years COVID. And after COVID, what has happened? Not only in Malaysia, the number of factories has increased, but during COVID, you see rubber is found in Malaysia, Thailand, Top Glove, all this. Okay, even Top Glove operates out from Thailand. They buy the rubber from Thailand, they have factories there and they sell and they make. But during the COVID, until the first 2 years after COVID, a lot of new factories has been set up in Vietnam, Thailand and China. Initially, they don't do well because they haven't got the health standards. To sell all this medical product, you need to go back to US and Europe to make sure you get the health certified. It's very hard to get the certificate. So first year they produce, they have to sell the things very cheap because they haven't got the health certification. But later, once they get it, they could sell to the US market, the European markets. And our glove company got extra competition. Not only a glove company, it's people who supply things to the glove players. So this kind of environment, if you are lending, you must know what impacts on them. Health certification. So the competition just doesn't come from Malaysia, it comes from outside of Malaysia. Okay, you see here rosy economic environment. Not every day is a sunny day, okay? Like glove players, sometimes it can be the sun is still shining, but because you got clouds from other players overseas. Okay, so the economics, the conditions different. This one, you look at it, is quite common sense. Okay, you look at the core business, bread and butter or not, the critical or major cost components, where does it come from? If they need to buy rubber to make gloves, where is the rubber trees coming from? Okay, will they be extra tariff? So far, ASEAN countries, we are quite friendly with each other. We don't impose so much tariffs. But if you look at it, certain major components, semiconductor, what happened in US impact on our semiconductor industry? What happened in Europe? What happened in China? US and China fight also impact on us. On us, the country, and on our borrowers, Do you all have semiconductor players in your books? Yup, RHB? None of you lend to semiconductor or players connected to semiconductors in any way? Electronics? You have to know, okay? Changes in external environment, social, political. I give you this example. My own customer import grains from Ukraine. When they import, all these years they've been doing well. Suddenly, their conflict with Russia comes out. Okay? So, they have to turn to alternative countries to buy the grains. It's a supply problem. Their demand, their buyers are still there. They have to quickly switch to other countries to source for the grains. Same thing like coffee, matcha. If you are selling in any way coffee, matcha coffee, then you know matcha is now in hot demand. The price has shoot up very high. Cash flow statement. Just now we calculate all the OIF. Okay? It unmasks all accrual concepts. They show you actually cash comes in. Is it profitable? But is that cash flow to service or not? You can see it from here. OIF. Okay? Just remember these three components of cash flow. These are net working capital, debtors, creditors, stocks, all this, okay? These are the first three things, yeah? Why they repeat this is because these are the practical aspects. This one was a lot of theoretical, okay? When you have a lot of sources of cash, it's positive, okay? So, just now I give you a good example. When you buy stock, you use cash, so it reduces, okay? When you sell stock, you sell already, you get more cash. That is how you remember it, okay? When you collect debtors, debtors go down, you collect cash. When you pay creditors, you use cash. So it's either sources of cash or users of cash, okay? Here will tell you interest paid. Remember, this is under financing, right? When you see interest paid. Drawdown of loans, is it positive cash or negative cash? Drawdown of loans. Can you remember?
Positive.
Negative cash.
Positive, When they repay loans?
Negative.
Negative.
Below negative. When they get dividend?
Positive.
Positive.
When they pay dividend?
Negative.
Okay, very good. These are only a few things that can, because it's an exact topic, but they will just recycle okay? Once you understand the theory or the basis behind it, no matter how they ask you, you will still know. When, okay, you see a company got negative cash flow, first year, second year, but when does it become acceptable or unacceptable? Do you know? It's possible, if you have a big company, sometimes in the expansion period, they need a lot of money. It's a growth period, but company A could show you negative. Company B say, wow, it's a growth period, it's good time, I have surplus cash. Then you compare these two, company A, company B in the same industry. But one is negative, one is positive. So it's not isolated analysis, you dwell it deeper. Okay, then you see why. Can it be acceptable? So, if you find that it is not for a prolonged period, it's only 1-2 years when they are expanding, then you say it is okay. It can still be acceptable. If the negative is not too huge, okay, and it is not a sign of over trading, it is still acceptable. Just like us individuals, we have been working, then you save money to buy a house. Then 1 year you buy a house, you got enough money to pay deposit. Then you need to renovate. Then suddenly you see your, my credit card statement go up. You takut tak? Some banks may love you because you use their credit card more. So same thing, you say, I use my credit card more because I want to renovate my house, I want to buy furniture, but I'm expecting a bonus from RHB. So it is still okay. It's not a sign of overspending. So it may not be a sign of over trading. Okay? Then you look at it. Is it caused by poor housekeeping here? Poor housekeeping means poor cash flow management. Some management like to spend a lot of money thinking that they'll make it back. Just now I give you this example called London Biscuits Berhad. It's actually, they borrow from many banks in town, For many years, for more than 10 years, they have been expanding. It was still okay. Banks were still comfortable. They show negative cash flow, but after that, they have enough sales to service. Then when it comes to the second generation, they have very poor financial discipline, very poor housekeeping. Then the gap becomes widening until they cannot pay one day. Then Nova Scotia Bank call on it. If you Google, you can find all this information in the internet. Okay? Because when they take action, it's reported in the news. Then you see if it's acceptable is the cash, the main source of cash is greater than tax and financial obligations. Why is tax so important? Why is the word tax brought up here? Do you know? If tax is the first thing we must pay to the government, cannot hutang. If you want to hutang, you must write to the tax department and get them to agree to give you a schedule, to pay. If not, the government can come after you. Yesterday you study, right? If you haven't paid tax to the government, what can the government do? Private caveat, landholders caveat. Hey, practical aspects, this one I must teach you. If you hutang the government in any way, especially tax, and you got land, they can put registrar's caveat, okay?
Yes.
So tax is very important. If a company were to fold up, and you get the liquidator to come in, they have a priority of payment. They owe creditors, they owe banks, they owe their staff haven't paid salary, they owe the government. Which one must they pay first? They may even owe shareholders because they've declared dividend, they haven't pay out in cash the dividend to their own shareholders. So if you are an accountant, a liquidator, for example, or receiver manager and all that, you must use the money in the schedule provided in the act. And the first thing is you must pay off tax. Then you must pay what is due to the staff, If they haven't paid EPF for some time, they must pay. If they have not paid SOCSO, they must pay. Then they must pay the staff salary. Then baru you go down the line, okay? Trade creditors, unsecured creditors, secured creditors, and all those. Let's say RHB Bank, you have lent a customer 10 million, they become insolvent, you have a lend of 5 million, okay? You have clean exposure 5 million. Then you say, I'm secured. But actually, your clean part, you don't rank above the others. If you're an accountant, you must go down, follow the priority. You understand? Okay, tax is very important. Payback to the shareholders' dividend is at the bottom. Subordinated loan is right at the bottom, This part is tell you cash flow analysis. You can see how they spend money, capital expenditure. Okay? Okay, this part is to tell you the capital structure. If you are in a financial analyst in the capital market, you always want to see how much of it is ordinary shares, how much of it is preference shares, how much of it is warrants and all those. Then you will propose accordingly. If you're a commercial banker like us in this room now, you look at the working capital, you look at the capex, you look at the trade financing. Okay? That is why all this breakdown is important for us to know. Okay, the next level, the next one is the practical aspects. It's called creative accounting. Do you want a 10 minutes break here? I stop for 10 minutes. Yeah, now it's 4:10. Okay, then we come back, we continue the last bit, and I think we can finish on time. Okay? And then you look at it. If there's anything that you want to ask me later, you can, yeah? Okay, see you in 10 minutes.
Okay.
Thank you.
还做了什么事情？
我拿了 leave 嘛，我不懂会不会 cancel 我的啦。我拿了很多 leave。我 整个2个礼拜不在诶。
有什么好笑的样子？
然后他问我，他 approve 了，他问我，他一开始他问我，我讲我拿3张考试，我之前就跟他讲过我要考3张了，他就讲，study leave 有多少天？我就给他看这个 table 咯，有9天啊。然后过后taking together， 我讲一个 sitting 在 November， 2个 sitting 在 December，然后是过后他就讲，说信我，他讲如果你拿的话，谁会 cover 你这2个星期的 payment？ 还是你会 settle 完 before 你 on leave？ 我讲不可能。
settle 完了。
呀，他没有脑的、啊。
他们是一直会进来的吗？
对啦，然后是写，我写他讲 because of last 2 weeks of the year end would be preparing for the year end closing。他讲 last 2 weeks preparing year end closing, make it on leave， 从17号到29号。我17号到31号有什么不同？我都还2天罢了。那他跟我讲这种话嘞，然后是结果呢？
而且 year end closing 跟你有关系咩？
我就是做 year end closing。
你不是做？
我是做 AP。然后是过后他之前还跟我们讲过什么嘛？就他讲他原本要拿那个 week 的，就是 Mickey 拿掉那个 year end closing， 他要去中国玩，然后现在 Mickey 拿了他拿不到，他那是1月尾，然后是现在我又拿，他又在那边叫，你合理吗？完全不合理嘞。然后是他还叫我去跟 Arabelle 讲，现在是怎样 ？Arabelle 明天就 on leave 了嘞，on leave 差不多要7天8天。你要我在好 on leave 之前跟他讲这种东西，他会开心吗？
讲什么？
讲Arabelle 你可以 cover 我吗？你看他叫我嘞，他讲 because of last 2 years 我们要 preparing 那个 year end closing， 他讲我可以 check with Arabelle is able to cover you during the period。Cause it's almost the entire second half December。哇，然后你叫我去 check， 你不应该自己去 check 咩？
你就讲咯，有啊，你就有 check yourself 啦，就这样。不要想那么多，你就直接把球丢回去就可以了。看一下我同事回不来。哎呀呀！
金钱好久。
Hi everyone. Hi, I'm sorry, there's a power trip in my area. I can reach you all only by my handphone. So Master Trainer Mr. Paul will take over from here, yeah? Because from my handphone I can't share the slides with you. Okay? Thank you, Just hold on for Mr. Paul, yeah? Thank you.
You all saw my screen? Hello?
Yes.
Yes, yes.
Good. Just one, huh?
Yeah, saw your screen. Thank you, Paul.
No worry. So, thank you to Puya. Give Puya a big hand. Emoji, please. Emoji. You've done a very good job. Emoji, please. Thank you.
Thank you.
Emoji,
Well
emoji.
done.
Thank you very much, everyone.
Okay, so let's go for the last laps. Now it's 4. Let me check. Now it's 4:26. We shall stop about 5:15. So I'll only touch you on the important part, and I think with Puiwa, I think we have done very well, and she have highlighted the important points, and even the calculation was very well done. And I presume you all quickly go and registered for the exam after the mock exam, and then show can pass. Let's go to creative accounting. Now, anyone is creative accounting against the law?
No, it's not.
Maybe no.
No.
No, yes. So long it did not evade tax. Remember, so long you don't evade tax. And normally accountant will do the necessary creative accounting for the companies. One reason, to avoid tax, payment of excessive tax. Number two is to help the owners to understand the importance of reporting of every disclosure item. So everyone know that. So the accounts are tailored, made to the favorable position of the business. So window dressing, they call it. So I know for accounting it's called window dressing. So take this picture. Now the bank also do window dressing, especially now, November, December, October. The pressure for what? Recovery. Recovery must be done within 31st. If your closing is 31st December, they say recovery must done before 31st December, so that they can claw back the interest, and also claw back they call it clawback, and of course the NPL will be lower. NPL presume will be lower. Number two, they pressure you for what? For loan drawdown, put in more paper before December. Very normal. When I was in Stanchart, when I was in UOB, I saw in Stanchart I was the relationship manager, and we were asked to put in the paper by 31st December by hook or by crook, and must put in more paper so they approve, so that the loan growth to meet Bank Negara requirement, to meet the ROI. Yeah, the owner's return on investment or equity. Number two, also to hit our target. Then the other item is CASA product. Must do window dressing on FDs, on placement. I call a few customers, no choice. Please help us to place some money into our bank, an FD or money market. So what happened? Liquidity go up and show a better result. And of course, the other point is we ask them utilize before December. Sounds familiar, right? Is it familiar?
Yes.
Yes.
Hey, I want deposit. Now I want utilization. OD, don't use you don't use Wow, capital stuck. The bank don't make money. So ask them to utilize, call them up. Hey, please utilize 50%. Or they utilize OD for a while. For a while. Then in January come, oh, please pay back. Utilization, trade finance, FX, foreign currency. Oh, open current account, transfer some money over, big amount, all that. It sounds familiar. So it's not wrong. It's not against the law. We do window dressing. Okay. The important point of window dressing, highlight this, valuation of closing stock. Always come up. Expenses capitalized. Expenses capitalized. Okay. Sometimes they come up with unrecorded cash deals. So what is valuation of closing stock? Let me ask this question. If you value the closing stock at lower than the actual, what happened to gross profit? Anyone? Say the actual is 50,000. You value the closing stock at 10,000. Very good. The what? The sales minus cost of goods sold. Cost of goods sold is lower, right? When you value the stock lower, let me check. What's my question? What's my question? Anyone? Valuation of stock is at. Wait, let me check. Is at lower. What happened to gross profit?
Higher.
Purchases no change. Closing stock no change, but your opening stock no change, but your closing stock lower. What happened to GP? What happened to the actual profit? Is it higher or lower? GP increase. Hafizudin, GP increase? GP higher? Let's see. Okay, so you can see that. There you are. You see. Any inventory here no change. 4,000 inventory. Beginning inventory means opening stock. Purchases 11,000, so you get cost of goods available for sale. Then you value your inventory supposed to be 3,000. You go and understate it. My question is lower, so understate it, correct, to 2,000. So cost of goods sold is 13,000. Previously was 12,000. So what happened to profit? Lower profit. Remember, inventory, we lower it down, the cost of goods sold will go up. So the profit will go down. So you pay lesser tax. The cost of goods sold overstated, lower profit. Okay, lower profit, Yeah, lower profit. When we value the stock lower, the cost of goods sold will go up, and what happened to profit? Profit will go down. You can see here. Okay, same thing. So remember this methodology. Remember. Remember, valuation of closing stock can have impact on the financial statement of the comprehensive income statement. Then what happened? If we declare lower profit, it can create hidden reserve. It can create conservative. It can create hidden reserve for the next year. Supposed to increase the retained earnings. Once you make more profit, your retained earnings go up. What happens to the equity? Up. What happens to gearing ratio? What happens to gearing ratio? If the equity
Low.
is up, low.
Very low.
You will show that because in your loan covenant you put that debt equity ratio must maintain 3:1, and then they just do it. It's not wrong, huh? Yeah. So now the valuation of stock doesn't follow MFRS, don't follow the old format, the GAAP. Now you follow MFRS, weighted average stock pricing, or they call it mark to market. Mark to market is the best. It depends on the market. Yeah, on the market. So when they say old stock cannot sell, or they call it what? They call it obsolete stock cannot sell. So they lower down the price. Okay, remember valuation of closing stock. So they will tell you this scenario. What happened if the valuation of closing stock is value higher now? So purchases plus opening stock minus closing stock is higher now. So your cost of goods sold is lower, then profit goes up. I'm going to show you good profit. You can play with. So a lot of companies do that, valuation of closing stock, and they create havoc in the, they call it accounting scandal. Look at Hi-Fi Break. Yeah, they use closing stock. They use invoice financing. No sale, create sales. Transma Air. Public listed companies or more. Okay. Silverbird, who produce Hi-Fi Break, our famous Hi-Fi Break, gone. Okay, a lot of accounting scandal. Unrecorded cash sales, especially when you are dealing with cash business, high risk or low risk. High risk or low risk cash business, restaurant, mini market,
High risk.
stores.
High risk.
Yeah, high risk. Because why? They don't want to record. What happened to, if they don't record cash sales, what happened? What happened to the sales figure? Drop. And then they pay less tax. And this one can be lead to lembaga hasiam negeri, evasion of tax. A lot of people don't record cash sales. I was consultant for a Miri company many years ago. He got bakery, 7 shops. He got supermarket, 19 shops. Imagine, break, don't record. End of the day, he come and take cash. And what happened? Even the post system, they can create it. Yeah, they just issue. Restaurant number 1, normally they don't record if they play the slip. And even post system, they can play with. Yeah, POS, post of sales. So remember, unrecorded cash sales is creative accounting. Third one is high dividend declaration. This one is capital leakage. Okay, so they declare high dividend. Who gain the most? Directors or shareholder? The director or shareholder? Those shareholders like 1-2 unit, like Hong Leong Bank, the directors own more share, or the shareholder who are buyers, who just trade, buy and sell, who gain the most dividend? If they declare high dividend. Hello? Let me check. Anybody have type? If they declare high dividend, who get the most money? Directors, the owners, or those one? Yeah, the directors, because they own about 24%, 30%. Look at the public bank. They own 20%, 24%. When you declare dividend, you get the most. Okay? The directors are the one who own a lot. In companies, same thing. The shareholders, the major shareholder always get more. And I just buy Hong Leong Bank maybe 5 lot, I won't get a lot. So that's why sometimes the reason why they declare high dividend, because why? High dividend because why? Capital leakage. They want to cash out. And sometimes the directors have a lower tax bracket compared to company tax. Remember that, huh? Highlight that one. Highlight, huh? Directors, because of the lower tax, and it leads to capital leakage. Cash flow drop when declare high dividend declaration. So remember, high dividend equals to capital leakage, cash flow out. Okay? High directors fees. High directors fees, yes, happen. The money goes directly to the director, especially when the company normal 2,000 and directors fees. Where can you declare, or when can you need to propose a director's fees increase? Where? Which part of the accounting? Remember? During which period? Must table in which meeting high directors fees? When we need to increase the high directors fees. At which meeting?
Board meeting.
Yes. Member public must be AGM. All public company must have an AGM. But for Sdn Berhad not listed, how they want to have their table account? How? Remember? No need to have AGM, but what they do?
They submit form.
Yeah, by speculation, you're right. Jun Tian, you're right. By circulation, they just circulation. Okay, by board resolution, and then they just sign. Like me, I have a company in Miri, we just sign. I don't go for AGM. Okay, remember that, So that's called director's fee. Now, dividend upstream normally to the holding company. Happen. Bank in Malaysia owned by Singaporean, they sure plow back the dividend upstream. And there's also capital leakage and cash flow drop. Yeah, dividend upstream to their holding company or ultimate holding company or investment company. So this is called creative accounting. To what? To reduce the tax. It's not wrong, They can just upstream. Yeah, their dividend. Dividend come from where? Profit, retained earnings, retained earnings. Don't forget. Now, expenses capitalized. This one is a very, very famous question. What's mean by capitalized? Expenses capitalized. Yeah. Anyone? These are the capitalized expenses that did not charge out on the P&L, comprehensive income statement. So what happened to profit? Up or down? Yeah, profit up. Did not charge out. But what happened to the fixed asset purchase? Or the fixed asset after cost of renovation capitalized? What happened to the fixed asset?
Drop.
Increase or decrease the fixed asset?
Increase.
Yeah, up. So affect affect lending. Means what? We lend more, and actual fixed asset price cost of purchase is lower. So we actually over lending. Impact because example of cost that can be capitalized. For example, building. What can be capitalized? What can be capitalized for building? Yes? Anyone? 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 What can be capitalized? Renovation, you are right. You are right, renovation. That's where companies keep on renovating and renovating. Look at banks. They keep on doing renovation. They keep on add here, add there. Even businesses like hotel. So what happened to the value of the asset? Increase. That's why the Western very smart. Every 5 years renovate. And claim depreciation. So that's why all the expenses renovation add into the asset and the asset increase. So for machine, we also can purchase of machine. Suppose actual pricing is RM 1.5 million, but the invoice is RM 1.8 million, and ask for financing. Why suddenly can increase? You check in the market, it's 1.5 million, but the invoice show 1.8 million. Why? Because of capitalization. What can be capitalized? Installation, shipping costs, commissioning of the machine, technical training, all that can add in. It's legitimate. So what happened to the balance sheet? The fixed asset bloated up. And what happened to financing? Up also. Okay? So that's why sometimes we need to do quotation. We need to do double checking in the internet to check what's the value of this machine. And we ask the customer, they capitalize. So remember, in exam, they may ask you, what are the example of expenses that can be capitalized? All this, like what you written, installation, shipping, commissioning, okay, transportation, okay, for building, renovation, add on, yeah, okay. Now AI building, everybody want go what? ESG building, they add on, so what happened? They gain charge out, profit show good. They want to show creative accounting of profit good, they capitalize. Because of ESG, because of AI, they put now intelligent. The building now, you go to this RHB. That day I give a talk on your learning week. Yeah, too easy. Everything is AI. Yeah, just go in. Yeah, I went to another building, Exim Bank or this SME. Just see the facial go. Airport. Our airport now, all using AI. I just came back from Cambodia. Surprise. Wow. 12 years ago, all are greenery. Now, all are concrete jungle. I got a shock. Lexus car is the most. And everybody is robust. So different. And go to the building, also AI. fantastic. I go to airport, AI also. Very. So what happened? They don't charge out. They capitalize. Okay. Capital reserve changes. Remember? We all say what? If there's a capital reserve changes, it can affect the formula of financial analysis ratio. Return on asset. Return on asset. Profitability ratio can affect, okay, on the asset that we purchase. So that's why capital reserve changes, we must look whether the RE has gone up or dropped. First thing, look at the equity of the 2 years. Once the equity increase, is it because of the profit or because of RE? They convert to bonus issue, or reduce because of paying dividend, the RE. Okay, the equity never changed. It's mostly bonus issue. Clear? So it can affect the ratio. Remember, capital reserve changes. Yeah. For example, revaluation of fixed asset can create capital reserve. So RE and capital reserve. Capital reserve can, like what we also can only pay bonus issue. Convert to bonus issue, cannot pay dividend. This one very rampant. Especially those yang berhad. Even public listed company do it. Send them to overseas for seminar, actually holiday. Come back, claim. Claim on the company. So this is called creative accounting. So remember, these are the items that can create. So in the exam, valuation of closing stock, high dividend declaration, example of capital leakage, expenses capitalized. Okay? So please read the notes. It's all in your notes, which I'm not going to go through. So my summary here will help you. Take this picture, my summary will help you. So only about 1 to 2 questions, guaranteed come out. Guaranteed come out, 1 to 2 questions only, not many. So don't spend too much time. Just understand the concept. Okay? So the notes are all here. Yeah, unrecorded sales. Okay, falsification, they call it tax evasion. So in the exam, they ask you, tax evasion, creative accounting, unrecorded cash sales. Okay, high dividend, high director's fees. Okay, to compensate the director. Okay. Expenses capitalized. Can take this picture if you want. Which I wrote R&D cost, shipping cost, sell machine cost, transport, consulting cost, legal. Legal, don't forget. Legal fees is also considered as capitalization. They capitalize it. Yeah. Insurance cost. Yeah. Okay. So remember, capital reserve changes, it can affect the gearing ratio. Gearing ratio, they call it total debt over equity. Yeah. Okay. Or total bank borrowings over equity. So what happened? If capital reserve drop, the debt equity ratio goes up. So as a lender, as an examiner, candidate, you must able to link with the ratio. What happened? What happened? And normally they ask the scenario. Okay. So gearing ratio down. More committed, total debt over equity. Yeah, that means what? The equity go higher. Okay. Revaluation of reserve they put in. So what happened to equity? Went up. What happened to the gearing ratio? Went down. So it shows more commitment. Principle of proportionality. Okay. Yeah. Personal expenses. Okay. Personal expenses. Okay. So last topic, qualitative analysis. Just remember, qualitative means what? The 5 C's. But in banking business, we cannot use 5C in our write-up. Let me check my time. I think of 15 minutes. So qualitative analysis, this topic normally come only about two questions. 1 to 2 questions, qualitative analysis. And normally they catch on management. So it's called non-financial. Everything is non-financial. Non-financial assessment of the company. So management is not about character. Are they very aggressive? Right now, aggressive. Are they conservative? Are they thriftiness? Thrifty means they not spend money. Are they extravagant? Wow, go for holiday, give the director holiday, okay, all this, or sit business class, all this. They call it extravagant, spend a lot of money. Okay? And when you look at management, look at the character. Look at the reputation. Right down there, reputation. Also look at the competency. The competence of the management. Are they competent or not? And also look at the organization chart. Write down. So write down. Character. We look at the behavior of the director. Are they very aggressive? Then you look at the organization. Do we have proper people in the organization chart? Responsibility, yeah? Then look at their competence management. How long they have been in the business, track record, vintage, yeah? So write down here. Shortcut learning, So shortcut learning, you put all here. When you read, you put all. So when you look at this slide, cover everything. They must have line authority. They must have proper organization chart. SME don't have. One director kick all. Is he very autocratic, the director? Autocratic or not? Under character. One man decision. Okay. Is there any control? Are they very aggressive? Keep on diversification. Wow. Are they risk taker? Write down character. Risk taker. So many things here, character. So just remember, when we analyze on the qualitative analysis, the management talk about the history of the company, track record. Talk about the competencies. Talk about the team of management. Are they qualified? Not qualified. They got organized. Talk about the risk taker. Are they risk taker? The high risk or low risk taker. Then talk about their behavior on their spending and their reputation. Okay? Then condition, talk about the industry. Talk about environment. Talk about regulation. Just remember, PESTO. Political, economic, social, technology, environment, legal, and regulation. When the company business is affected by geopolitics, affected now. If the people like Pokong, like those gold shop, Habit Jewel, is affected by gold price. Silver price has shot up. So they are laughing to the market. They bought a lot. They haven't made into gold chain, all that. They are laughing. Okay? They are laughing to themselves. They bought it. Industrial regulation, tariffs, especially Donald Trump now, put a lot of is it very competitive? Hotel, not so. Depend on location. Mini market, yes. You can see Speedmart and KK always together one. And then 7-Eleven. 7-Eleven is for convenience. Those people want to just buy and go off very fast. But for shopping, they go to Speedmart. For KK, take and go, cheap. They target the low market. So condition of the market now is very competitive. Because why? China product is getting cheaper. Just recently, I read steel bar. Lion may exceed the oldest steel factory in Malaysia, M Steel, which I give financing during Stanchart time. They may exceed. They say, now the price is so cheap from China. Yeah, furniture, I'm from Muar Johor. Also affected by the tariffs. Also affected because they cannot export to US. So 19% they download into our furniture, but they know how to cut corners. I don't tell you the trick because my nephew is inside. He tells, yes, you want the price, I can give you. You want this shape also, I can give you. They cut a bit of hoon, small inches, they really cover the cost. But you cannot see. That's why consumer must understand the product, must go and look properly whether small thing you cannot see. Sometimes the steel bar should be 1.5 inches, they give you 1.2. You can't see also. Yeah. So environment now, ESG, very important. Regulation for sure. Every country have protection, especially now. They protect their goods, they protect anti-dumping, especially this regulation. Very important. Singapore, same thing. Yeah, same thing. Affected. So condition is qualitative. Accounting policies. Remember policies, SPM. Principle got 9, doctrine got 4, policy got 3. So are they liberal or not? So right down here, liberal policy. Regulation link on to government, environment link on to pollution, industrial can be a lot, whether it's very competitive, whether it's uptrend, downtrend. Remember the graph that Jay teach you? Sunset, sunrise, product life cycle, growth, introduction, growth, maturity, decline. That one should come out. Industrial cycle, economic cycle, product life cycle, guarantee come out. Put a note there. Yeah. Accounting policies, are they liberal or not? Are they inconsistent with the market or not? Yeah. Are they inconsistent? Remember the doctrine? Consistency. Yeah. Okay. Position, guarantee come out. One question. Guarantee always come out in the last. Position put there, hedging tools. Hedging tools. So you either buy short, just remember right now, buy short or sell long. I repeat again. Sure got one question. This examiner love it position. They love it because it's very confusing statement. Just remember, buy short or sell long. Write down, positions guarantee come out. One question. You either, remember in stock market, because short selling or sell short. Okay, so let's go to sell short first. Short selling means, just remember you're in the stock market, Bursa Malaysia. You got no Maybank or you don't have RHP shares. So you go to the market, you got a CDS account, you go and buy. No, you go and sell short. Certain counter allow, not all counter. You must tell your reminder or your stockbroking firm, can I sell short or not? Meaning what? I expect the price to drop in the afternoon. I sell short. So I sell first without any stock in my account. So I buy RHB at say $4.30. But with the expectation afternoon, before closing 5 o'clock, 4 o'clock. Remember? I short selling. So I got to buy and cover back the position. That's called hedging. So in company, the question come out like that. The company has signed a contract right now. The company has signed a contract in selling in advance. So they call it selling in advance. In advance, for 3 months. But production or purchase of raw material not yet done. This is called short selling. So you sign contract first. Well, because what you expect that the selling price may drop, or the purchases may increase. So you quickly go and sign contract so that you can do hedging when you buy the raw material or production later. Remember, you don't have goods to sell, but you sign contract. That's what happened to all the what they call it chips company, and also Samsung handphone. Yeah, they buy first. They buy first without Samsung handphone ready or iPhone ready. They just buy first all the raw materials. Or they sell first. You remember? Remember this iPhone? They sell first, but don't have stock yet. That's called short selling. Okay, clear? Short selling. So buy long. Sell long. So wait. Let me see. You short selling, sell short, or buy long. Buy long means what? You buy first raw materials, but you don't have sales. You buy the steel bar first. You sign contract with China to buy all the product, or with Thailand, and you sign. For example, there's one company where I did, when they know that the China garlic, that month production a lot, they buy in container. Selling haven't started. They buy, come back 7 container and store in the cold room. So that was production very cheap. Then they start selling. They make money. Same like durian in Malaysia. They know that the durian come in December and May time, or January time, Chinese New Year. Chinese New Year sure got durian on. So what happened? They go to the plantation and buy first. They buy first without any sales. So what happened? They go to the plantation and buy. They say how much fruit is going to bear. I buy first without selling. That's called buy long. Okay, buy long, not sell short. So to cover back, now January they start selling. March they sell. Now the company in Klang, they buy durian and frozen it. So that's why durian can have 24/7, 365 days, because they frozen the durian. With the ultimate, where there's no supply, what happens? The durian price goes up. There's a demand. With tourists coming in, they like durian, but the price goes up. But they buy cheap. They buy the raw material cheap and sell long, high. So remember, long and short should come out. Goodwill, just write down there, is a brand image builder. Seldom come out, but once in a blue moon. What is goodwill? Goodwill is like RHB. They have been here for so many years. If you sell, sure got goodwill. The buyer got to pay you goodwill to the owner. I remember when UOB buy over OUB, Singapore Bank, you have to pay for the goodwill, the brand name. McDonald's brand name have a goodwill. So when you want to open a McDonald's shop or take over, you pay for the goodwill. Goodwill, Company manipulate goodwill and close down. Especially when they buy a buy the goodwill from a shell company. They pay a lot of goodwill. They suck out the money. Can be player. So now goodwill cannot be amortized now every year. Yeah, they are according to value of these auditors. Okay, all in the notes you can read.
Mr. Paul, what is pastel art?
Yeah.
Pastel art.
Pardon?
Condition. What is pastel art? PSTL. The
Pastel. Yeah,
pastel.
Political, economic, social, technology, environment, legal, and regulation. This talk about condition, under condition. Okay, do you get it? Political, talk about economic, region, social, the changes in the culture, the people, the Gen Z. Talk about technology, especially AI now. Technology keep on changing very fast. If the company is linked on to technology, you talk about condition. Do they upgrade or not? Then talk about legal. Are they subject to legal formality and regulation? Government. Put a government. Thank you.
Thank you.
Okay, so character, talk about integrity, dependability, experience, all that you can read. Yeah. Okay. Yeah, are they separated? Remember? Separate entity. Okay. This one already done during the training of Company Act. Yeah. Private, no transparency. Public, yes, SC. Bursa Malaysia. Company Commission. Yeah. Okay. Yeah. Diverse. Remember keyword here? Diverse ownership shareholders can lead to squabble. Came out in the exam. Shareholder squabble means to quarrel. Partnership always lead to squabble. Yeah. Then the company closed down. Disadvantages of diverse ownership. So exam will come up. What's the advantage of diverse ownership? Because of expertise. Disadvantages, squabble. Lost direction, everything. Okay. Remember that, Yeah. So you understand the strength and weaknesses of the company. Yeah. The risk attitude. Are they risk taker or not? It's all in the note. Read up. So I was cut short so that you understand. So experience. Do they change? It's very normal. Do they change? Yeah, are they still doing the old thing? They never change. Now using AI, they're still using the manual. Gone. In the long run. Okay. Change management. Yeah. Okay. So read this. This one sure got 1 or 2 questions. Not many. Don't worry. Yeah, the most is 2. Okay. Industrial cycle which you have studied. The environment, the demand risk, the competition, the regulation, the government. Regulation always linked to government. Tariffs. Look at EV car. They're going to take off the tariffs. They're going to take off the subsidies. Okay. Evaluate. Yeah. So environment, talk about demand and external factors and competition. Environment. How's the environment? Competition. Okay. The demand risk. Yeah. So now a lot of business are in the decline if they are not using digital or AI. They already matured. Pharmaceutical already matured. Yeah, already matured. Yeah. They are not going to decline because there's always evergreen pharmaceutical product. Okay. So talk about demand related risk. Yeah. Any changes in remember the social, environmental, social. Yeah. Any changes in the taste and effect, especially fashion. Yeah, fashion. Okay. Is it technology intensive or not? So you can read up all the environment. So it's actually pastel. Remember pastel? Talk about condition, you talk about pastel. Plus 1C, competition. Yeah. Yeah, external factors. Business cycle, talk about government monetary policy, social economic development, inflation, war. Look at the war. Yeah. The trade war between China and US, political instability, Korea, keep on changing the prime minister now, even Thailand. Okay. Power failure. That's called also lead on to condition. Condition means external. External. Plus the competition. Regulation is government. Okay. Is there any subsidies? Is there any grant? Is there any tax incentive? Tariffs they put on. Okay, regulation, government. Yeah. So we just read about 2 questions. Last one is called common reflex. Let me see my timing. Yeah, 5:15. Give me another 10 minutes. So take this picture. Normally 1 question or 2 questions, not many. Auditor's report, as what we want to say. Qualified, reflect. Accountant keep on changing, reflect. Auditors keep on changing, reflect. Write down here. Auditors changing, reflect. Qualified report, reflect. Auditor's opinion, reflect. Or accountant keep on changing, reflect. Discretionary managed cost. By the word discretion means what? Company can manage the cost to increase profit. I repeat again. Discretionary managed cost means company can manage. No need to do. Can no need to do it. The activities to manage the cost. That's why discretionary means budi bicara. At the discretion of the directors. Example, during recession, during COVID time, you don't advertise. You don't do promotion. You can control R&D. Don't you do R&D? Don't you do renovation? Or don't you do innovation? Or training? You stop training. Yeah, a lot of company, during pandemic, during downturn, inflation, they don't do training because it's a discretionary cost. Advertisement, promotion, they reduce it. Yeah, just remember Asia, during pandemic, they don't advertise. They keep quiet. Training also don't do. During inflation, cut down. So, in exam, they ask this question. What are the examples of common red flag in discretionary managed cost? Example. They ask for example. R&D, promotion, marketing, innovation, training costs that can help the company to reduce costs. Just called manage. Remember, this one very often come up. Auditors, very easy. Change the accounting policies. They change from policy, remember? Policy, prudent, substance over form, and materiality. Okay? Prudent is at the discretion. For example, accounting policy. Depreciation from straight line to reducing balance. Profit goes up. Deferred taxation is another accounting policy. I don't pay tax first, ask for defer. Can. That means what? Profit show good. Okay? Or change accounting period from 31st December to June 30th. Because the composition of sales can affect the profit. So three things, remember, accounting policy, deferred taxation, change accounting period, and also depreciation policy. They may ask you example. Okay? Intangible asset increase. What's intangible? That cannot recorded in the balance sheet or P&L. Intangible means cannot touch, can see but cannot touch, can hear but cannot touch, cannot feel it. Example, goodwill, licensing, brand name, copyright, AI, intelligent property rights. These are they are called intangible asset increase. Yeah, in their off balance sheet, brand name. So can also create red flags. can bring up the company price or company worth. Okay? Non-recurring source of income. Just now Puiwa said, non-recurring means nothing to do with operating business. Example, one-time gain, rental. One-time gain, sales of fixed asset. Commission, agent fees. FX gain, put the FX gain. Yeah. Also consider non-recurring source of income. That means one-time gain or nothing to do with operation. Can be common reflex. Okay. They put into the financial and show good profit. Gain from sales of fixed asset. Okay. Reserve fluctuation, same thing. Yeah. Retained earning fluctuation tremendously, suddenly change. They want to show you that the equity has gone up. Huge profit. Okay. Suddenly there was an increase in reserve. Actually, there's no sales. They can create profit. Okay. Liberal accounting policy, yeah. Don't collect from debtors. What happened to your liquidity ratio? Don't collect debtors. Debtors don't collect. What happened to your liquidity ratio? Current asset over current liabilities. Show good or no good? Late collection. Up or down? Current ratio. If you don't want to collect. It show good, huh? The current asset is more than current liability, but cash flow no good. No good is cash flow. So the ratio goes up. Current asset over current liability 3:1 because they don't want to collect the debtors. Okay, weak collection policy. Manipulate of sales figure, they can happen, and of course losses not accounted for. They don't want to account for the losses. They write off. Yeah. Okay. Gearing ratio 7 times, 6 times can be reflected. That means what? Over borrowings. Put there, over borrowings, over reliance on debts. So common reflect only 1 or 2 questions, not many. So normally they ask you example of discretion managed cost, auditor's report, non-recurring source of income, liberal accounting policy. 4 of them, very important. Put a note there, highlight. Okay? Then you read my notes, it's all there, which I told you indirectly. Yeah. Okay. Discretion managed cost, yeah, R&D, maintenance, everything. Don't want to do during bad time. Change the accounting method, yeah, from reducing to or deferred tax or change accounting policy. Okay. Yeah, intangible assets. Okay. Non-recurring source of income, yes. Yeah, here. Gain from disposal, gain from retained interest, gain from disposal or investment. It's all non-business related. Reserve fluctuation, yeah, they play with the reserve to show you growth. Okay. Withdraw dividend, yeah, fluctuation. Okay. Liberal accounting policy to show you good profit. Yeah. Revenue too early when product is shipped without ownership transfer. This one happened to Server Dynamic. Project haven't finished, recorded as sales. How can? Yeah, they got a lot of project, letter award, a lot, put in as sales. What happened? Loaded up, red flags. And what happened? Suspended. Liberal accounting. Is it justified? No. Over gearing. Too much step there. Yeah. Too much step. That means what? Financial leverage, over reliance on debt, over gearing. Okay. Short long, I already told you already. Yeah. Buy raw material first without any sales in hand. Buy raw material means buy long. Short, sell first without any stock in hand. That means you haven't produced. Came out like that. Okay. So long and short, guaranteed one question. You must know. They call it hedging. Two. Committing to purchase or taking title without offsetting sales commitment. Okay. Long means you buy first without sales. Short, you sell first without any goods on hand. Without offsetting purchase commitment. You don't buy raw materials. You don't have raw material, so you play with hedging. Remember this, huh? Guaranteed one question. But don't worry, in the mock test have. And I guarantee you go wrong one. The question, number 80. Just watch out, huh? One of the mock question, number 80, always happen. Okay, a lot of people go wrong. Goodwill, just remember, it's an image builder. They got value unless you sell. Maintain goodwill without any write-off is seen as attempt to preserve the report annual profit. Yeah, you don't write off. Normally, must write off goodwill. So what happens? Your profit goes up. Any questions so far? Thank you. Any questions so far? So when is your mock exam? Huh? Which date?
7 November.
Yes. It's a face-to-face in Bangi. I love Bangi. They got waterfall. They got this what they call it, the what lotus. They got this greenery, very fresh air, and they got good food, and they got good hotel. Okay, welcome. Say see you. No question. Yeah, thumbs up to Kuiwa. Yeah, thumbs up to yourself.
And thumbs up for Master Trainer Paul as well.
Okay.
Hey class, yeah, I've just posted a QR code for evaluation. I need your help to fill in the evaluation, yeah? Thank you so much, yeah, everyone. Please help me to fill in the evaluation form for your feedback.
Okay.
Thank you.
Thank you.
Bye. It's a repeat.
Bye.
Thank you.
Good night. See you. Enjoy yourself and ready for the exam. Bye.
你们几时要考啊？
Mock test.